So welcome to the Berkeley Entrepreneurs Forum. This is something we do every month, and we have everything from VCs, angels, and lawyers to tell you about how to raise capital for your company, to entrepreneurs. We do a wide range of different subjects, from web and mobile to energy, clean technology, and it's great every month. You can visit us at entrepreneurship.berkeley.edu and sign up for our mailing list, which I encourage you if you haven't before. You can also check us out on Twitter. We are UCB Entrepreneur. And if you want to tweet about tonight, the hashtag is BEF for Berkeley Entrepreneurs Forum. I couldn't be more excited to introduce tonight's program. Fenwick West has been a longtime supporter of the forum. Sam, Angus always puts together a fantastic event, and it's no surprise if you look at his bio. He's a lawyer with Fenwick West, and he's helped Junglee with their $300 million acquisition by Amazon, the acquisition of Jamdat Mobile, and he's been doing it for a long time. I noticed you've got Airbnb on there, a very hot company right now, is one of his clients. He also does mentoring hours at the Leicester Center, I might add that. So there are all kinds of reasons to seek out Sam if you have an active startup and the whole firm of Fenwick West. And without further ado, I will bring up Sam to introduce the program tonight.
Thank you, Andre and Kirsten. I'm blown away by the response here. This is absolutely amazing. It's a great topic and one that I think is extremely timely. We're going to review sort of the venture capital, the state of affairs for venture capital and angel investing. We've got a great panel, which I think represents a range of investors. And we'll provide some hopefully interesting, provocative, and insightful comments. But before that, I want to introduce the one and only Steve Bengston of PricewaterhouseCoopers to give his money tree presentation, which is always very interesting and provides a nice backdrop to what the panel is going to talk about. I've known Steve for years and consider him a friend. And without further ado, let me bring up Steve.
Thanks, Sam. We'll get into the real numbers now. But first, I want a brief interlude to talk about Apple. I'm sure most of you know about Steve Jobs' announcement yesterday, and apart from the personal tragedy for Steve, I mean, Apple's a great metaphor for what we're talking about here because it's one of the great venture companies of all time. I've got a couple of personal connections that most of us probably have an Apple story, but by sheer coincidence, I live 2 blocks from Steve Jobs. So I go by his house all the time, so it's very heartfelt. But also a guy from my business school class of many years ago, a guy named Trip Hawkins, who went on to fame at Electronic Arts and a few other places, but he happened to be the first non-engineer at Apple. And a couple reasons that's interesting. One, when he told us he was going to go to Apple, we'd never heard of it. It was an unknown company. And yet, in the span of our lifetime, it went from being a complete unknown brand new company to momentarily having the highest market cap of any company in the world. And so I think that's part of what brings us all here as investors and service providers to this area of technology, because you can see massive change in much shorter time periods than really any other industry in the world. With that, we're going to talk about venture capital trends in the U.S. This is something we've been doing for 15 years or so, and if you want more information, there's a couple free websites there that will have 1,000 times what we're going to talk about here today. This chart tracks venture capital investment in the U.S. by quarter over the last handful of years, and you can see it's been kind of up into the right, and then collapsed in 08 and 09, and then went back up. And it's a little surprising because we're probably going to talk about a lot of the issues that are in venture capital. I mean, it's an industry that's in disequilibrium, because for the past couple of years it's invested much more then it's raised. The exits don't support the current level of investment. So something has to change. And despite that, you can see investments actually up so far in 2011. In fact, if you have a historical perspective, we're on track to do something like $25 billion of investment in the U.S. And even though that's down from certainly the peak years and down from just a couple years ago, it's way above anything before roughly 1999. So even though there's certain vicissitudes right now, we're on a very high base compared to historic norms. This chart gives us an idea why we're having this meeting in Silicon Valley and why it's packed, because this is the mecca for entrepreneurship and venture capital around the world. You can see that roughly 40% of the venture deals happen right in Silicon Valley, and another 10% happen in Southern California. So half the venture capital in America goes into California, and that's been true for quite some time. This is the exact same data, but just ranks order. So you can see the dominance of Silicon Valley versus New England, which is where the industry started. I mean, 50 years ago, New England completely dominated venture capital. And about 20 or 30 years ago, Silicon Valley took over #1, and now is quite dominant. And I think there's actually a good chance that in the next 10 or 20 years, Southern California is going to take over from Boston for the #2 area in the country. This gives you a sense of Silicon Valley's not only the dominance, but how it's changed. One of the things that's interesting is you think of all the cities in America, or all the regions that are trying to be these Silicon, fill in the blank, Silicon Forest, Silicon Sand, Silicon Alley, et cetera. And you would think over time that they would slowly chip away at Silicon Valley's market share. But in fact, you can see the exact reverse has happened. When we started these slides in 95, Silicon Valley had about 20-some% of venture capital in the US, and now it's consistently in the high 30s, even 40%. It's actually gone up. So there's really been a very distinct flight to quality, and which is, was not obvious when this all started. This chart has lots of numbers on it, but it tracks venture capital investment just in Silicon Valley. And this is dollars going into Silicon Valley. You can see over the last 15 or so years by quarter. And this is all deals, so Series A through Series Z. And if you can read these numbers from way back, you can see that, again, 2011 has gone up in Silicon Valley. About $2 to $3 billion is getting invested each quarter, and I think about a third of it's from our panel. So they're very active, and they all have big wallets, and they love to talk to people after the panel. The next slide gives the exact same data, but it's the number of deals that are happening, and a similar trend in Silicon Valley. Again, 200 to 300 deals are happening each quarter. So a lot of volume. I mean, you remember, there's 12-week quarters, so a lot of deals are happening just in Silicon Valley. But you might ask, what about Series A? Hasn't that kind of collapsed as VCs have gone later stage? And you can see there certainly was a depression, so to speak, of Series A deals recently, but it's gone back up. So in 2011, you can see it's heading back up and to the right. $200 to $300 million of Series A deals just in Silicon Valley each quarter. And if you look at the number of deals, again, it's 50 to 100 Series A deals. In fact, the 110 in Q2, you can see it was one of the highest quarterly numbers for Silicon Valley in the history of the reporting. This charts investments by round. And it's not clear what the message is, but it just shows you how much money is at different stages. Not surprising, there's a lot of money for Series A, B, and C, but even later on, D, E, et cetera, there's still a lot of money going into deals. In fact, there was even $10 million that went into a Series S deal. And that's not for Steve. And I don't know, how many of you have ever been in a Series S deal? See, no one ever admits it. It's like these deals happen, you can never find who does them. But we'll look at a couple charts just by industry, and this has not changed much in the last couple years. Software is almost always the #1 category, has been for almost the entire period of the money tree. Biotech and medical devices have been 2 and 3 for quite some time. So the main changes here is you're seeing some other categories run. It's kind of, there's more depth to the large categories, and industrial and energy, which is really a surrogate for clean tech, has fallen a bit. It's been 2, 3, 4 for the last few quarters, and you can see it fell to whatever that is, 6 or 7. And so clean tech's in a little bit of disarray as the industry transitions from a lot of these bigger capital intensive deals to more capital efficient models. And this just shows you how that's changed. You can see software's basically been number one almost every quarter for the last few, but otherwise, you can see the various market shares of the other categories. This tracks the investments by stage. No big surprise here. Most of the money is in expansion and later stage, and that has changed over the last 10 or so years. And if you look at the same data by round of funding, you can see that the biggest chunk of money is going in the 5th round and beyond. And 10 years ago, that would have been a very small number. And that's one of the reasons that returns have been modest by historical comparisons over the last 10 years, because there's so much money that has to go into these companies for such a long period of time. If you look at the good news is if you're lucky enough to raise money, and here's a quick pop quiz, what percentage of people wandering around Silicon Valley ever get any money? And the answer is 0.5%, roughly. So for those of you that are out fundraising or want to be entrepreneurs, just know this is a hard game. It's something that people don't talk about very much, and certainly coming from schools like Berkeley, you always assume you're going to raise money. But the statistics are not quite as optimistic. So just keep in mind this is a tough slog, and you got to work hard and get lucky. But the good news is if you get money, you're likely to get quite a bit, at least by historical standards. You can see the median has been about 3 or 4 million over the last few years. And in fact, the 3 million you get now, probably has a lot more purchasing power than the 4 or 5 million you got several years ago, just because most of the things people spend money on, especially in software companies, cost a lot less now than they did a handful of years ago. These are the top 10 deals in the US, and a couple of things of note. One, Silicon Valley is just 3 of the top 10 deals, so that's a little lower than normal. But also, remember, this is in an era where the median exit is something like $80, $90, $100 million. And yet, you can see all of these deals except one are at or above the median. So this is a little bit like Garrison Keillor's joke about parents think all their kids are above average. And the same thing there. Everyone thinks these are going to be the big winners. But this is true every quarter. There's always quite a few deals that are getting a lot of money, even in an era where VCs talk a lot about capital efficiency. These are the most active investors defined by just number of deals. This could be Series A through Series Z. It doesn't matter. And it could be anywhere in the US. You can see where they're headquartered, but most of these people do deals all over. Anyone from Kansas in the audience? Okay, well, if you want to go home, there's hope now. The next one, what are we looking at? The exits. There's a lot of numbers here, but the main news is the IPO market has had a brief resurgence in the last year. I think the jury's out whether that resurgence has come to a grinding halt now with the chaos in the markets. But you can see there's been a few more IPOs the last few quarters, the last couple of years. We had 75 venture-backed IPOs in 2010, and we were on track through the first half to do about another 70 or 75. Right now, that number looks pretty unlikely. So we're probably going to have a dip this year, and certainly either of those numbers is a far cry from the numbers we saw in the mid to late 90s. M&A is a little healthier. There's a lot of transactions. That's the good news. The bad news is there's a lot of compression on prices unless you're in a particularly hot sector. Fundraising I alluded to earlier. VCs have invested 20 to 30 billion a year over the last couple of years. And you can see in 2010, they raised 10 billion, 2009 they raised, 13 and 16, and they're on a path. They were on a path to do pretty well, but Q1 was a little misleading because there were a few mega funds that raised money, and Q2 kind of went back to the new norm. So fundraising is still very difficult, and there's a lot of VCs that are very concerned with raising their next fund. So there's a lot of summary. There's a lot of good news and not so good news. We've talked about most of this, but I will allude to the advertising bullet point, which is we're still in the early stages of a migration of media from traditional platforms of movies, TV, and where the big money goes to the internet and mobile. And a couple of facts. About 7% of media dollars right now go into the internet and mobile, and yet we spend about 20% of our media time on the internet. And one truism of media advertising is those numbers tend to converge over time. So I think over the next 10 or 20 years, you're going to see a big onslaught of media dollars that go from traditional media into internet and mobile, and that's going to fund a lot of the investments that you're seeing now. But things aren't also good. We've alluded to most of these things. Returns have been very modest by historic standards the last 10 years in the venture industry. The government is coming in with more regulation. The VC market itself is in disequilibrium. A couple things that are going on. A lot of VCs are not doing new deals. They're concerned about raising their next fund. A lot of job creation historically in the industry has come through IPOs, and if IPOs go down again, that will reduce the number of jobs that get created through venture. We talked about fundraising. I'll just touch on a few of these. A prominent VC recently did I'll call it an informal study that claimed that 97% of the profits in the industry come from 15 companies every year. Let's say there's a little hyperbole on both ends, but even if you think 90% come from 30 companies, it still begs the question of how many VCs do you need to find the best 30 companies every year? Right now the answer is about 3,000 or 4,000. They vacation a lot. But one of the things you hear a lot these days is, the industry is bad, but my portfolio is great. So there's a lot of concern about portfolios throughout the industry, and a lot of funds that have not raised money in the last 3 or 4 years are probably in deep trouble. Globalization is a theme. I'm sure you've heard a lot about China and India. Get most of the press, but we're seeing a lot of activity in South America and Russia and other countries. I won't touch on each of those points, but just focus on a couple. David Rubenstein, the head of Carlyle, happened to mention that China has been the #1 economy 15 of the last 18 centuries. So just because they've had a couple bad centuries, I wouldn't rule them out. They're used to being on top. But despite that, India, the current population change, is actually going to be #1 in population in about 10 years or so. And that could change the conversation about where the largest domestic markets, which translate into more venture funding, et cetera. And with that, I'll turn it over back to Sam. Sam.
Thank you, Steve. As always, very entertaining. I'd like to invite the panel up now while I introduce them briefly, and I'll ask that once I do, you give a short synopsis of your focus and who you are. As Steve said, this is a very interesting time. A lot of contradictions in the numbers. A lot of deals getting done very early stage, but exits are depressed and there's a lot of price compression. You don't see a lot of more difficult to raise money for venture capitalists. So this will be a very interesting panel. So to my right here is Aydin Senkut. He's the founder and president of Felicis Ventures. Aydin focuses on seed financings, has been doing it for years, formerly was at Google. Next to him is Howard Hartenbaum, a partner at August Capital. Howard was one of the founding investors of Skype, and before that, after that, was at Draper Richards before August. And last but not least is Joe Kraus, a partner at Google Ventures. Joe is a two-time entrepreneur, co-founder of Excite at Home and JotSpot as well. And so, gentlemen, let's get started. Given the time, we have about 40 minutes, I'm told. So the focus of today's panel is on the state of early stage investor investing. 2008, 2009 saw a collapse in the market, mainly due to the financial crisis and the mortgage crisis. Since that time, the market's come back with a vengeance. And in fact, there's talk today of there being a bubble notwithstanding the comments that Steve made. And you see in the press and you hear investors complaining that valuations are out of whack and that entrepreneurs have unrealistic expectations. I'd like to get your perspective at a high level on the general state of the market for early stage at this point.
So certainly there's an upward price movement in the market, but I also think that the market has gotten a lot more sophisticated. As for myself, I've been an angel for 5 years and a small seed fund for the last year. 2 of the biggest deals we've done were outside of the US. That doesn't mean we're still doing 90% of our deals in the US, but it just means that all of us venture capitalists have to work that much harder to find those great founders and great companies. And that's one of the things I think makes it really interesting. 15 companies generate 97% of the profits, but you got to find out where they are. But I also think that the market fluctuations continue. But as long as you find great companies, those will also make up for the great exits. The best companies don't always come very cheap.
Anything to add?
I don't know. I guess what I would say is it's always dangerous to opine on this particular topic, because how do you know when you're actually in the bubble? The last time we had a bubble, I think there were, a few 100 million people online. Today, there's estimates of like 2 to 2.5 billion people online. So yes, prices certainly feel inflated at the low end, but at the same time, the market is probably 10 times bigger than it was the last time we experienced a bubble, and prices aren't 10 times higher than they were even kind of pre-bubble. So I don't know. I would argue that yes, certainly prices feel high at the seed investment stage, but the other piece is that the market is so much bigger than it's historically been.
So all of us invest our funds over a multi-year cycle. So just because prices rise and fall during that time period, if we perceive the prices are a little bit higher, maybe we do a few less deals during that time period. But on average, as long as you don't pile all your money in when the market is at a very high price, on average, portfolio mechanism works for an investor.
Yeah, and the other piece I would say here is that, it's FOMO, or fear of missing out, drives a huge amount of investor behavior. It's really actually troubling. And so you get in these cycles where memories are short, prices go up quickly, and the prices tend to go up quickly not because the deals are necessarily better, but because FOMO has a way of being very contagious. And so I think that maybe we're in a slightly heightened sense of FOMO going on in the investing world right now.
And to add one more thing from your guys' perspective, if you're hearing about these really high prices for deals and investors are making quick decisions and they're investing money at high prices or convertible notes with no prices on them, and that seems all great until you realize that because it's easier to raise money, you have 4 competitors that were funded that are exactly the same as you who got funded very easily. And the end result the initial result is, wow, look at the great price we got, look at all the money we raised. But the end result might be all 5 companies fail because they all fight against each other with too much money. So what you may think is a blessing may actually be quite bad for everybody in the mix.
Yes, venture fratricide is the term of art.
Well, couldn't another dynamic be in play here besides, what do you call it, FOMO?
FOMO.
FOMO. You've got a change in how expensive it is to start a company. It's now extremely easy, cost-effective. Things that used to cost a lot now cost very little. You've got what you described, Joe, as a huge class of people who are now online. And we also have a couple cycles of new, successful entrepreneurs who have a lot of money to invest, and who may be interested not in making money, in returning investment to limited partners, but actually to getting involved in helping entrepreneurs. Not to say that any of you aren't interested in that as well. So I'd be curious to get your perspectives on the rise of this class of angels and super angels, and what type of distortion or effect that has on venture generally, on the bigger funds, who traditionally would invest in Series A rounds, but now are competing, in some cases, with swarms of angels.
Well, again, I would say it's kind of a mixed blessing. If angels are investing a lot and the prices are higher than a professional venture investor might do, it may seem great and you decide to take the money from angels at a great price, but then 2 years from now when the economy is in a crappy situation and prices are very low and you need money, you don't have a partner who can give you money, and you have a bunch of angels who get scared because their stock portfolios are down, and you say, I need $500,000 to make payroll, and they're like, sorry. But if you had worked with a professional investor like any of us, when times are tough, we have reserves and money set aside for our companies to keep them helped out. So it's sort of it's a, like I said, mixed blessing, or it's a trade-off, and you have to make the decision. Do you want, the most money at the highest price in the quickest amount of time with the least due diligence, or do you want somebody who may be a longer-term partner? You may have to sell at a slightly lower price or even a significantly lower price, but it's somebody who will stick around when the times are tough, who can help you out. And it's just a trade-off that entrepreneurs have to make.
There certainly is the trade-off. I guess it is happening, though, that this sort of competitive landscape for early seed stage investment is happening.
Yeah, I actually think it can be great. And the reason is that it's, so there's some interesting data here. First, half of all the deals that made for fund makers, essentially the biggest deals, turned out to be undersubscribed in their A and B rounds. What does that mean? What it really means is that professional pickers like us are really actually not that good at picking. We think we are, we tell ourselves we are, we want to believe we are, we're all trying to do well. But the reality is the data would say we're not as good at picking as we think we are, or perhaps the people that give us money think we should be. As a result, more things funded at the bottom probably yield more opportunities for those in the later stages of investing to actually pick among winners without having to fund them. So I actually think it can be good overall as long as people stay somewhat disciplined. And discipline is not an easy thing as an investor, again, with FOMO being a driving force. The second piece that's in there is that I think traditional angels are taking a huge amount of risk that they don't necessarily understand. If you actually look at the numbers, the mean return in seed investing is quite high. It's depending on which studies you're looking at and which data sets you're looking at, between 23 and 27% IRR. But what's poorly understood is how much diversity you need in order to achieve that mean with any reliable likelihood. And it turns out the number of deals you need to achieve the mean returns in the seed space is between 80 and 100 per fund. Most angels can't do 80 to 100 deals. They just don't have the capital to do that. And the reason that is that angel investing, just fundamentally, as much as we think we're good pickers, is buying lottery tickets. And the reason is that, having started a couple of companies, and I'm also a very competitive poker player, in any time, they're related,
Elaborate.
Yeah, anytime I'm playing a single hand, I could be playing against the world's best player, and I have a legitimate shot at beating them in that hand, because luck plays a huge role. Over time, skill emerges, and I would lose a lot of money to that world's, the best players by far. In any given seed company, luck plays a huge role as to whether that company succeeds or fails, which is why a portfolio is really necessary to actually achieve and find one of those lottery tickets that explodes and makes all your returns. And so it's true in any stage of investing, but it's particularly true at seed investing. And so I just think there's some interesting cognitive dissonance between A, professional investors thinking they're better pickers than they are, B, angel investors who have limited portfolios are taking far greater risk than they think they are, and C, the real amount of diversity you need to actually achieve and pursue a seed-based strategy is much bigger than people think.
Well, I think from, just to add to that, from your perspective, I think it's a good thing. When I started angel investing 5 years ago, I think the active angels, I would say maybe were in the 2 digits, at least in my network. Now there's probably, I can say, hundreds, if not thousands of angels, and I think that's a really good thing. It gives you so many more opportunities to get funding. I think the scene has gotten also a lot more sophisticated. I don't think it's just about angels and VCs. Now you have some new sites like AngelList and Kickstarter that kind of gives you other options. I think that's a good thing, but that still doesn't get you to a successful company. And I think, one of the other side of what Joe is saying is that not every investor is created equal. Obviously, first you need to get funding and make sure you have enough cash to you run your company. But I think more and more we're seeing that the investors that are rising to the top have operational experience, and they're making a big difference for their companies in terms of critical moments in their company's life. And sometimes that's as important as the cash, if not more important. And if you can strike a good balance between those two, you're likely to do very well.
Yeah, and I don't mean to suggest that angels and VCs, their strategies are in conflict. In fact, I think there's a lot of
cage match.
A lot of harmony there, actually, because the most interesting dynamic that I've observed as a service provider is who controls a lot of the decisions that get made around funding. Who controls the deal flow? And 10 years ago, it used to be VCs marching up to Sand Hill Road and making pitches directly to VCs. But what's happened now is you've got this class of influencers, and Aydin touched on them, who get to these deals very early and now have become almost gatekeepers of some sort. But that can be, I think, a very cooperative relationship, because a lot of these gatekeepers and angels don't have the wherewithal, as Howard pointed out, to fund companies that need expansion capital, or just to be able to continually fund companies round after round. What are your thoughts on that?
Well, let me add a point to that. I mean, I think Joe had some really great numbers, and I certainly agree with some of the things he mentioned. But the one thing I disagree with a little bit is that investors can't be pickers. One of the interesting realities that I found in experiences, when I look back, our fund had 12.5 exits, and I think that's enough data points. And I look back and say, okay, what were some of the common stats? And I think when I look now, what are the companies that are doing well in our portfolio? Half of those did not come through our door and ask us for money. Those companies were actually doing extremely well, in some cases never raised money, and we realized because of our focus, we need to go find these companies and get involved with them. So it's an interesting dynamic, right? I mean, I participate a lot in these panels, and I really want to work with a lot of great entrepreneurs. But also the reality is, if in our space, if you want to be successful, sometimes it means actually getting a hold of those entrepreneurs that are doing really well, that are bootstrapping, that might need financing, and become their partners. So it's not about capital, which I believe is a commodity, and it's not. For the right people with the right plan, the marketplace works itself, and the capital finds its rightful place. So I would just add that perspective.
So I don't want to argue with Joe on data. We sit on a board together, and he's a lot smarter than me. So I won't go with disagreement there. I will say that Aydin has proven himself to be a good picker, and the numbers bear that out. And one thing to think of, and Joe comments that you can't really, show to be a good picker, but one thing that's not obvious in the venture industry is while there may be hundreds of venture capital firms, there's probably 20 or 30 that actually make money consistently over time. And frankly, I think Aydin has come in. He looks like he's coming into that group, and good for him. So the point being that picking or not picking, the trick is to be at the high end of the food chain and see the best deals and have a chance to look at them because you're aggressive and you go out and find them, or because your firm like Sequoia Capital, for example, everybody beats on their door to get in there. But by the time the top 20, 15 or 20 venture firms have said no to a company, the odds are it's probably not one of the big hits. And then it moves down to the other venture firms who didn't have first crack at it. So it's not like every firm has the same chance to pick at every company that comes out there. It's actually the top firms have the opportunity to pick first. And then once it's picked through, then it moves down. So it causes a slightly different dynamic, I think, than just it's a mutual fund type of situation.
Yeah. And there's no doubt, sorry, being the Google guy, I have to be data-oriented, I guess. There's no doubt there's strong performance persistence in the venture capital industry, meaning those firms that have been on top tend to persist and stay on top. And there's a lot of interesting questions as to why, and I don't think it's a well-answered question. One of the things that is true, and this is from an entrepreneur's point of view you should think about, one of the key determiners of success from a data point of view is how well networked are you and how well networked is your VC. or your angel investor. Meaning there's a very strong positive correlation between high network centrality of investor and high network centrality of the entrepreneur. Let me give you some examples. If you're an entrepreneur and you're based in New York and that's where your network is, if you move to San Francisco, and let's say, sorry, you're in New York, you've started a company before. It's had a successful exit. If you start another company in New York, you're over 50% more likely to have another success than a first-time entrepreneur. That data is pretty well studied and understood. If you move back to San Francisco outside of your network, you revert to having the same chance of success as a first-time entrepreneur. And the primary reason is you lose your network. What does losing your network actually practically mean? It means that it makes it harder for you to hire because you don't know people to hire right away. You have fewer people that you can vet. And it means you operate more slowly because you can't ramp up as quickly. Second is you actually have a harder time putting your company. I have a belief that most companies are sold, not bought. You've got to get people interested and kind of juiced up about your vision. A lower network means that you basically have fewer opportunities to get into people easily that are trusted and actually put your company to them if the time if you've reached the time where you need to do that. On the VC front, there's an odd phenomenon, which is that as a VC, you actually have an incentive to do deals with highly networked investors as a syndicate partner. Because it turns out if I do a deal with a highly networked syndicate partner, all of my deals benefit, not just the deal we work on together. So Howard's firm, August, is a highly networked central investor. The fact that we're co-invested in a deal together means that all of my other deals benefit. Probably because since Howard and I have a relationship, he'll give me advice on some deal that we're not together in and help me make a connection. So the advice back to you guys is, as you think about who you're taking your money from, network centrality of your investors matters quite a bit. And making sure you're staying in your area of where your network is really important.
Excellent, excellent point. What about relationships between entrepreneurs and investors? It seems to me that the odds change dramatically if you've had a success. If you've had a success versus a first time, that is a huge risk mitigation from an investor standpoint, especially if you've had a success with that investor.
Let me take a different point on that. I wish I had more organized and structured data like Joe. I'm really enjoying actually listening to him. But one thing that I found is that, especially we just had a meeting on it today, interestingly enough, most of the companies that we're invested that is doing well are first-time entrepreneurs. And some of the celebrity deals where you have entrepreneurs that are kind of a well-known quantity or commodity is not necessarily doing better. Now, of course, I'm talking from a very limited set, but one thing that I wanted to bring up that I'm really happy that Joe mentioned about the network, one thing that's different about being on the panel this year for me versus last year, up until last year, I was investing my own money, and I felt, I'm sitting across the table from entrepreneurs, and I worked for Google early on, but I never raised money for Google, and it was the first time I actually went out and went to LPs and had to raise money for my fund. I was an entrepreneur like yourself. I probably had tens of meetings, and one thing that I learned is not only is it your job, number one, to network, but it was amazing how much I learned, not having anybody who's helping me, being a first-time partner, and having been told repeatedly that a first-time fund with a single partner basically doesn't stand a chance to raise money. I was able to raise money from really reputable investors, and it was amazing that I probably had 150 versions of my deck, and when I compare what I first started with and how ridiculous it looks to what it looks like 150 presentations later, I was amazed. I'm like, did this guy to some fundraising school or hired consultants? And it was pure, sheer resilience and experience and just like going one after another. And it was amazing how much I learned. Some of my best investors were third contact, like some investor who just like blew me off, that then I found some other investors who blew me off, who then like got me to the right investor. But the only way I could find that out was to actually go through those meetings. And I guess what I wanted to know is, I know it's really frustrating to show up to these things. You talk to investors, you don't get a response, and you're like, man, this sucks, this is terrible. I had like 10 of these things. It might have to be that you have to take 150 of those things. But that's, I think, the 5 or 10% difference between equally smart number of you, where like a 5% has that resilience, says, you know what, I'm not gonna give up, I'm just continue doing that. That doesn't mean they're much smarter of you or better than you, but they might just have a slightly better plan and stick to it and just stick through until there is a yes at the end, wherever that comes from.
Yeah, I want to double down on persistence here for a second. That was a blackjack term, not a poker term. I do love gambling, I have to say.
And now he does it with Google's money.
Yeah, exactly. True. I'll tell a story from my entrepreneurial days. So I was 23 years old when we were starting Excite, which was an early search engine back in the early 90s. We had raised money from Kleiner Perkins. We'd raised $3 million, but it was in 2 tranches. We had $1.5 million in our first tranche, so we had $1 million left at this time. And we had launched the service, and back in those days, Netscape was by far the dominant browser. I mean, they had 8%, 100% market share. And there were 2 buttons on the browser, one called Net Search and one called Net Directory. And they were the beachfront real estate of the internet at the time, where if you clicked on search, Net Search, that went to one company and directory went to Yahoo. And so they had never put these buttons up for bid. They were just free traffic. And Mike Homer, the former VP of marketing at Netscape, got smart and was like, well, crap, this is worth a lot of money. So they put them up for bid. And there were 3 bidders, us, InfoSeek, and MCI. 3 companies that don't exist anymore, actually. And we had $1 million in the bank, and we were trying to figure out, what do we bid? And I remember this very clearly. We had gone around and around. We were sitting in my grungy office, and Vinod Khosla, who was our backer, was sitting on the floor, and we were debating, and finally goes, we're going to bid $3 million. And I'm like, Vinod, we don't have $3 million. What are you talking about? And he gave me that look, which he gave me for 8 years straight, which is like, you're an idiot. He said, look, bottom line is, if we win it, we're going to be able to raise the money easily. And if we don't, we're out of business. So we're going to bid $3 million. I went, all right, we're bidding $3 million. So we bid $3 million, and we lose. And Vinod was really the one who taught me this lesson the strongest time then, and it never ended. He said, we're going to act like it's not over. We're going to sit in their lobby every day unannounced. We're going to demand meetings with the VP of marketing. We're going to call the CEO every day. We are going to act like complete asses until we get this thing back. It is not over. And we did it. We literally did that for 17 days straight. I felt like an a-hole. And 17 days later, when MCI couldn't deliver, we won it back. And I will tell you today that we would not have sold that company for $6 billion had we not persisted. Persistence, as Aydin says, is the #1 key success factor in entrepreneurship, in my opinion. The negotiation begins at no. It doesn't begin when they smile and say, okay. So, a little personal story there.
That's a great story. Well, why don't we build on that? And I'd like to know from each of you, what is the most profound experience you've had as an investor? And from that profound, I mean the most important lesson you've taken away from an experience. And I know I put you on the spot here because I didn't give you any advance warning, but.
So I'll start and talk about entrepreneurs and boards supporting them in the case of Skype. And the lesson being, on the other side, saying no when people offer to buy you. And when Skype launched and had very early growth, a few weeks later at the next board meeting, one of the board members said, oh, by the way, the CEO of AOL called me and he offered $400 million in cash for your business. And I said no. All right, what's next? And the entrepreneurs stopped him and what do you mean? And $400 million in cash is a lot of money. And I said, well, yeah, it's a lot of money, but if somebody's willing to offer you 400 without having any data, somebody else will be willing to offer 800 if they see the data. And the entrepreneurs, they wrung their hands a little bit. And we went to dinner and they drank a little bit too much. And they said, God, I hope we're not making a mistake, but we believe this is a great company. And about 2 months later, a friend of mine from MIT, Nicholas Negroponte, who was running the Media Lab, who was good personal friends with Rupert Murdoch, calls me up and says, hey, Howard, would $850 million from News Corp do it to buy Skype? So I said, well, I don't think so, because I think they're thinking $1.5 billion. I just figured I would just double it. And so I called the founders and I said, didn't the board tell you it's going to double again? And they said, yeah, now the price is $1.5 billion. And so time went on a little bit further, and the next call was from Yahoo, and the number they said, well, maybe we could do $1.5 billion, and instantly the founder's price became $3 billion. And that is what they ended up selling it for the first time around. Right? And we all read that they sold it recently for $8.5 billion. So the truth being, if you have a company that's interesting and it's making progress and everything is going in the right direction, the fact that somebody wants to buy it from you and is coming at you and trying to pay for it, just always, double the price in your mind. And luckily, you'll be ahead of what the market is a little bit for that time being, but pretty soon you'll get that offer and you'll realize the longer you wait, the more it's working. Now, that's assuming everything is going in the right direction.
So let me take the other side of it. And first, let me start by saying I hope every one of you that are aspiring entrepreneurs end up in that situation. And you can say no to $400 million, and hopefully you get a better outcome. So the interesting part of it is, I think before I start from my own experience, I want to relate to 2 anecdotes that I had in my career. One was, we recently had a founder event, and really, really well-known investor came, and he was talking to about 80 of our founders, and they asked him, what do you look for in a company, and what do you think is a great asset in a founder? He said something very interesting. He said 2 things. Number one, he said, when we were raising our company, we had such a big vision that investors were willing to invest hundreds of millions of dollars with us. The second thing he said is that, when the entrepreneur comes and talks to me, what I'm really looking for is an idea that is so compelling that when that entrepreneur CEO goes out and is hiring their 17th employee, the 17th or 27th or 37th, it's still as excited as the first one, despite having much less equity in the company, that they so get excited about the vision that they still want to join the company and work for the CEO. And I think the moral of the story, relating also my experience of having had the chance to work early for Larry Page, it was one of the most intimidating things I've ever done, because everything that I thought, I'm like, oh my God, I've worked 24 hours a day, worked my butt off, he's going to like this. He would just look at it and like, that's crap, can do 100 times better than that. And what he really taught me is that as human beings, we're incremental thinkers. And we always kind of shoot low. And he's like, time is limited. You have life and you feel like you have a lot of time, but you don't. So if you're gonna do something, everything is gonna take the same amount of time. So do something that is really meaningful and is really gonna move the needle. And when I think back and think like, oh, I wish I could say I have a crystal ball, somebody comes in and I can tell, but there's been some instances like Mint, which was a really great outcome for me, where the entrepreneur came and he had a half-baked product, and he didn't come and say, I'm building some financial software. He said, you know what, there is a problem in the US, people have a lot of debt. I want to create a product that's going to affect everybody in the US and make them smarter about their finances and make them save. And he captured it. I mean, maybe it sounds really cheesy. Maybe you're like, oh yeah, of course, after the exit, you can say that. But he definitely came and he was so convinced, and he was like a prophet. I'm like, this is my thing. I'm gonna make this happen. And he sold me on it, right? And somebody else could have been maybe even smarter and could have had a better product. But if they don't have that kind of a belief of this is what I'm gonna do, this is how I'm gonna change the world, and somebody else comes into me and says, you know what, I have this product, it's like 1% better than this, and I don't have any employees, and if I raise money, I'm gonna build the product, that doesn't really capture my imagination. So I think it's definitely a food for thought in terms of, when you're doing something, I think it is really, truly important that you have gone through all the different things and skepticism in your head, and when you're talking about it, you've done your homework and you really believe in it and you're ready to sell it no matter what happens, even if it takes 150 or 200 meetings to get to the point where you need to get to.
Excellent, excellent. Well, let's talk about compelling ideas and what you're seeing more specifically, what you're really excited about in the industry, what your fund is focused on. What are the big ideas that you think are out there that you're going to invest in?
Everybody's looking at me. It's scary.
It's your turn.
It's my turn.
Clap for you, so you have a chance.
You know, I'm relatively new as a professional investor. I angel invested for about 10 years and then moved from a kind of a dabbler to a daytimer about a year and a half ago, almost 2 years ago. So I don't have the same level of experience, certainly, as Howard does as a professional investor. My own sense is that there's things you say you're interested in on your website, and then there's the deals that you do.
And what are those deals?
Okay, so, well, the point I want to make here is that serendipity plays a big role because the market is far more imaginative in aggregate than I am, and so seeing and hearing lots of interesting things, you end up kind of getting some sense of it's like hiring engineers. You know, you mentor founders, and somebody who's hired 10 engineers really has a hard time knowing good from great. But if you've seen 1,000 done 1,000 engineering interviews, you kind of know good from great. And I think the same is true in anything. As you see more and more deals, you have a better sense of what is an absolute maximum and minimum versus a local maximum and minimum in terms of something interesting. So for me, at least, the last deal I did was actually on the board, and I was kind of scared to see it on the board, which is Kabam. They're a social gaming company focused on hardcore gamers. So most of Zynga's audience is actually 70% female. Kabam's audience is 70% male, and I happen to love personally the gaming space, mainly because I think virtual goods is such a price-efficient way of making money in a game. So what I mean specifically of what? Yeah. So specifically, what's interesting, I think most people in virtual goods are more amazed at like why on earth does somebody spend all that money on nothing? But the more interesting kind of higher level point from a business point of view is that, you know, today in the gaming world, packaged goods gaming, everybody pays the same price. Everybody pays $60 for a cartridge. And a guy like me who has no time, I might play a game 3 times, and somebody who's hardcore might play it for 50, 60 hours. But we both pay the same price. It doesn't actually make any sense. Virtual goods allow for a far greater fit to the demand curve of what people pay. Because I don't pay anything if I'm just a casual player, and there are some people that literally will dump, I'm not kidding you, like $30,000 into a game. They obviously play it a lot. But that's really interesting to me, that you take an industry where everybody was paying the same price to much more of an AdWords auction-based kind of model where you have a much more efficient fitting to that demand curve. So that's why I happen to like gaming. So, I don't know. The end.
Sam asked, you know, what we're interested in, what we're looking for. I think there's, you know, generally 2 types of investors out there. There's those who like to kind of analyze the whole market and decide what they're going to invest in before they see it. You know, we are not we, but another fund might say we are a clean tech fund focused on the efficiency of solar technology. Or there might be a fund that says we focus on software as a service for enterprise supply chain solutions, or whatever. And there's that type of investor. We're the opposite. And we have a problem with this with our LPs, our investors, is they come in and we say we're raising a new fund and we would like their money, and they say, well, what are you going to do with it? And our answer is, we'll know it when we see it. And you know, we describe ourselves as being completely opportunistic, And if somebody sends us a presentation and it looks like other stuff that we've seen before, and there's 5 of them, or there are a couple are funded already, we usually just ignore it and say it's just not a fit. It's the things that we haven't really thought about that much before, but are new and creating a new market space that didn't exist before that catches our attention, and the belief being the most interesting companies are usually, interesting meaning the largest, are usually companies like that. And to give you a few examples in the past, and then kind of maybe 2 that I'm working on now. In the past, my partners backed companies like Seagate, Atheros, what if we could send, data through the air? Wow, what a wonderful idea. Wi-Fi chips. Intuit, Shopping, Postini, Xilinx, Microsoft. I mean, Microsoft had a VC. I don't know how many of you guys know that. He's a guy named Dave Marquardt. He's very low-key. He's been on the board for 30 years, and he bought in at a $19 million valuation. I mean, that was a good deal. Back at that time, Microsoft, that's a crazy company. They really, IBM said it's not possible. It's not going to work. 2 of the opportunistic investments that we did recently, one of them happens to be one that Joe and I were equal co-investors on the deal, is a company called Relay Rides, which is a person-to-person car-sharing company. It's basically think Zipcar, but our customers own the cars. So, we all own cars, and they sit on the streets unused much of the time. And Relay Ride's job is to make it available for our neighbors to use the cars when we're not using them. And the goal of the company is to get the average monthly check size up to $250, $300 a month, so that the people who own the cars effectively have their cars for free. And their neighbors who just borrow the cars whenever they need them and pay, like Zipcar, $7, $8, $9 an hour to go to the market or go to the doctor or take their dog to be washed. So everybody's a winner in that model, and if there's a company in the middle that's taking $1 every time somebody rents it, that could be a really interesting business. And when Joe and I were looking at it and thinking about the scale, we're like, wow, we never really thought about this before. How big can it be? And we kind of came down to the solution that if there's 245 million passenger cars in the US, and we can get 1/4% renting a few $100 a month, it's a couple $2 billion a year in revenue. So yeah, that's big enough. So we made the bet, and it's still an early company, but it's very interesting. Just to give you an example of a very opportunistic investment, we didn't sit around and say, oh, we should go find a person-to-person car-sharing company. The entrepreneur came in and said, listen to my idea. Another one I'm an investor in, which is in alpha testing. It's not available yet, but I'll talk. I'm sure they won't mind. It's a company called Bubbly. And what they have developed is the possibility to make a spherical photograph. So rather than looking at a photograph as something that's flat, that has been specified by the person taking the picture, instead you stand in the center of the picture and you look in a complete sphere through a device that has a gyro, and you can look up, or you can look down, or you can look behind you. And if you, when it's launched and you see it, you'll say, wow, teleportation exists. Because you can literally feel, like with a piece of glass the size of this iPad, you can feel like you're standing in another part of the world, and you're looking at what you want to look at, and it's actually just a spherical photograph. Now, we would never have come up with that, but some really smart entrepreneurs came and said, look what we're doing, and we made a bet on them. So if you're that kind of guy or girl, you come to us.
Well, I think we have a completely different approach than Howard, and I'm really glad
and
that
both work.
And I'm really glad that he's finding these great companies. When I mentioned to you that I was fundraising, I think what I realized is that you need to be that much more disciplined about how to stand out in a sea of investors. And what I'm seeing is that the time for a deal to close has come down from 3 months to like a week in some instances. So I thought, okay, there are like 10 to 100 times more investors. The time is like getting short. And I want to reach the world's best investors, best founders, just like every other investor. How do I do that? I thought the best way to do that is actually to earn it and to actually call your luck. And our strategy is really simple. I think there are only 2 things that matter in successful companies. Number one, they're growing really fast. So 18 months ago, when I looked at the industry, I said, look, there are 3 obvious things that are growing really fast. One is mobile. The second one is e-commerce. Trade is trade. It doesn't get censored. It's growing all around the world, especially faster outside of the US. And then the third thing was the change in enterprise. We don't really use install software anymore. 10 years ago, everything I did was install software. Today, I'm running everything in the cloud, and I run my business from my phone. So it's a completely different universe. And then the second part was, as an investor, one of the things we don't get control is, of course, we can go after entrepreneurs, but we don't necessarily see the entrepreneurs that we would like, again, the things that move the needle for people like Howard. I just am not the kind of person who likes to wait. I like to change my chances by being active about it. So I thought, what are the big markets that are so big that not only is there space for great companies to be built, but we are not seeing enough entrepreneurs. Healthcare, right? I must have seen 37 different mobile photo companies, but I probably seen only 5 entrepreneurs that want to build a software company in the healthcare space because it's tough. It's difficult, but it's also $1 trillion market. So I met an entrepreneur named Ryan Howard who's building a company called Practice Fusion, where people thought I was crazy to invest, where the guy mortgaged his house to start the company and sold his car and used the money to start the company and started with 5,000 practitioners. Now he has over 100,000 practitioners. And I also think about areas like education. We complain about unemployment in the US because education is broken and it has to be reinvented. And so I found this great guy from Apple that before iPad came out, he said, I want to build a company that's going to reinvent book for the area of mobile devices before even the iPad came out. And I'm like, that's exactly the kind of entrepreneur that I wanted to find in education. And that company turned out to be Inkling, and now is churning out some amazing products. You can check it out on the iPad. It's available. And then there are 2 other areas, energy conservation and personalized medicine. Again, each one of these are $1 trillion areas, and we're not trying to do everything in these markets. We're just trying to find software companies and great entrepreneurs that want to carve some new niches. Coming back to the comment also in terms of how you don't know what you don't know until it comes through the door. I also had this argument with, again, a reputable investor who told me, I'm not really sure your strategy is going to work. I think the exact example that was used was the Zynga of mobile is Zynga. And I said, the Zynga of mobile could be a different company. In this case, could be like Rovio, which, by the way, we're one of the investors, and took me 10 months to get into that deal. And I had to fly to 3 different countries in 2 different continents to be able to close that, to kind of make another point in resilience. And it turns out, and that company is now being used by 120 million daily actives. When I first started talking to the company, they had 12 million downloads. Now they have 300 million downloads. I think they have become a pop icon. I know people that made fun of it. It's just a stupid mobile game with a funny name. It turns out that there is more to it. So, again, I think I'm trying to put myself in your shoes, and almost every entrepreneur that comes through my door has tried to look me up on LinkedIn, read my blog, read anything about me in the news to know what I know. So I think as investors, we cannot be passive anymore. We cannot just wait in an office and wait for people to filter through and say, yeah, I kind of like your pitch. I'm going to put money into your company. That's a big idea. I think we really need to do homework. And the only way to kind of keep up in this fast-moving world where the deals are getting really close and some of the great entrepreneurs we might not even hear of is to actually put ourselves out there and make ourselves vulnerable, and also kind of like put it out in terms of what we believe in is going to work, to kind of put ourselves on equal footing with the entrepreneurs that are looking for funding.
Fantastic. I want to ask a last question before we move to questions from the audience. Steve, in his presentation, sort of pointed out how difficult, in the numbers point to how difficult it is to raise money. 0.05%, I think you said, actually are successful raising money. But the ethos, the sense I get in the Valley is that it feels much more active and easier to raise money. I've heard that failure is a very important thing, a very important part of being an entrepreneur. And I'd like to hear from each of the panelists either what you've gone through in terms of failure and what you've learned from it, either personally or from your portfolio company, and the lessons taken away from that.
Well, I have a few thoughts here. One is that I think one of the lessons that I also took away besides persistence was opportunity leads to opportunity in ways you really can't predict. My wife's grandmother had this saying, take a cookie when they're passed. And the funding story of my first company was an example of how one thing leads to another in ways that you can't predict, which I'll talk about here. And I think it relates to the difficulty of getting funding. It relates a little bit to persistence. I got a book when I was a senior in college called Accidental Empires. It was given to me by my college girlfriend. It was a gossip history of Silicon Valley. In it, the author says, tips for entrepreneurs, call me, I'm a cheap date. And my nickname at the company was Phone Boy. It still is actually my name. My job was just to call people who I thought might be interested in the technology we were building. So I call the author. We go out to lunch. He gets excited about what we're doing. He says he wants to join the company. We thought we had made it because this author of a book wanted to join our company. He ultimately didn't join, but he introduced us to the company he worked for, which was InfoWorld, which was a magazine at the time. This is back in 1994. And InfoWorld wanted us to take our search technology, apply it to their archives, and put their archives online and make them searchable, and they would give us $100,000 to do so. That sounded great to us. We were working in our garage and eating rice and beans, so we took the $100,000, and they said, if you do a good job, we'll introduce you to our parent company, IDG. And we did a good job. They introduced us to IDG. We went to a board meeting where we talked about what we had done. And in that meeting, one of the board members of IDG was a venture capitalist named Steve Coit. He worked for Charles River Ventures out on the East Coast. He liked what he saw. He said, hey, I'm interested in potentially investing, but I need a West Coast partner. So he introduced us to Jeff Yang, who is now at Redpoint, then at IVP. Jeff didn't know what to do with us, but he introduced us to Vinod Khosla, who in literally the first meeting, where everybody else was asking us, how are you going to make money? In the first 10 minutes, he asked us, does the technology scale? We said, we don't know. He bought us a $10,000 hard drive, which at the time was 10 gigabytes. And we thought, we really like this guy. He just bought us 10 grand of stuff. And he ultimately funded us to the tune of about $3 million without a business plan. And I could never have predicted that the book that I got would yield a funding without a $3 million financing. But the point is that every step of the way, we were saying yes to those opportunities and figuring out a way to do them. And I think that relates to the stat of like 0.5% getting funding. You just don't know how it's going to come together and how it's going to come through, and you can't predict. And so I've never found it. I mean, I love planning, but I've never found myself. There's the way you draw it up, and there's the way it actually runs, and those are often very, very different. Second piece, failure. I actually think failure is radically overrated. We all say this thing. We always say that we say it, and it's so subconsciously wrong. I think we say, "I've learned more from my failures than my successes." Actually, the statement is more valid as follows: I've built more character from my failures than my successes. But I have not learned more from my failures than my successes. And the reason is as follows. If you're in a company, you're running a company, let's say you make like 15 decisions a day, most are minor. You got to get several of them right. You got to get maybe like 10 of them right. Maybe you got to fix the other ones. You do that day over day over day. The combinations of all those decision paths over multiple years is enormous. If you fail, all you know is that one of the trillion paths that you went down, well, that one didn't work. But if you succeed, now you have an instinct about what to do as opposed to what to avoid. You have something to go towards as opposed to something to stay away from. And that's why I tell entrepreneurs, I tell audiences like this all the time, it is so much better to go find a culture of a company that you join that is about winning, that is winning. Go join a company. Don't go join. The first company you join, if you're going to do one, shouldn't be like a 3-person startup. It really shouldn't. Because the chances that you learn a gut pattern of what's working and what's not is very low. Go join a company that is in the knee of the curve, even if it's bigger, even if it's like 60, 70 people, because what you're going to pick up there is a pattern of success, and that's what you want. That's how you're going to do your first company well, is get that pattern of success. I really think we tell ourselves the wrong thing when we say, I've learned more from my failures than my successes. We build character from our failures, but we learn from our successes.
So, I'll end up with, I'll try and be a little more brief, just the
Ouch.
So the guy that I work, I've been in the venture business for 11 years. In the first 6.5 years, I was working with a guy named Bill Draper. Many people heard of DFJ. That's Tim Draper. His father is Bill Draper. Bill's father, it was also Bill Draper, was the first VC in Silicon Valley. So the Bill Draper I worked with, William H. Draper III, he has a book out called The Startup Game. If you want to read it, it's an interesting kind of self-biography with some lessons in there. He's in his early 80s. He's done the venture business off and on for 40-ish years. He founded Sutter Hill Ventures, which none of you have heard of, or very few of you have probably heard of. It's probably the most successful venture firm. You saw their name up on the list. They had done 13 deals. I haven't read any press on any deal that Sutter Hill has done, but their IRR for over 35 years is 34.1% per year. Now do the compounded math on that. So Bill started that firm, and he's been doing this for 40-ish years. And what he taught me was the venture business is a business of pattern matching. And the longer you do it, the more you go towards some things and stay away from other things. And I got 100 one-point lessons from him, which were really valuable to me. And if I had to pick, one of the top 10, and all of them are equally valid, but the one I'll just pass on to you from Bill is you never lose money taking a profit. No, that's my favorite one. The one that I think is most instructive is that capital-intensive businesses are an anathema to venture capital. And in my experience of investing in 40, 50 companies, maybe 45 companies in the past 11 years, the pattern that I've recognized that support what Bill has to say is anytime there's a company that's raising more and more money when it hasn't solved the most fundamental issues of his business is going to be a huge, ugly crater in the ground, and everybody's going to lose their money. The founders are going to have wasted 8 years of their life. There's going to be depression, divorces, and all sorts of terrible things. So if you look around at some of the companies out there, we do have companies, big name brand successful companies, Twitters and Facebooks and Groupons and Zyngas, and some of these companies all of them have raised $1 gazillion, and some of them raised the money after they had proven their business, and some of them are still raising money even though they haven't really proven their business, and I think that bodes poorly for some of those companies. The last time we had maybe many of you are too young for this, there was a company at the peak of the last bubble that collapsed called Webvan, which exploded $1.2 billion of investor money. They had never figured out the fundamental issues of their business, but they raised more and more and more money. And when I say capital intensive is an anathema to venture capital, which is what my dear friend Bill Draper told me, I don't mean it has to be hundreds of millions. It can be tens of millions of dollars. And if you guys are going to start a company, if you're getting into the 10, 15, 20 million range and you don't have a solid grasp on the reality of your business and how it all works, get out. Because you'll just waste your time and a lot more money trying to figure out what to do there. And so, keep yourselves lean and raise less money early on and make sure you figured out what really makes your business work as a business, and you're not a couple of years into it burning, $1 million a day like some of these companies that are out there right now.
Should we hear from the audience?
I think we should. Well, thank you. I want to thank the panelists first before we turn to questions. This is very, very good. I've been told that if you have a question to go to a microphone, so I don't know where the microphones are, but okay, right there. Well, why don't we start with you, sir?
Okay, so my question has one of two paths. There's what I see as incremental improvers in terms of your business, and there's next waivers. The next waiver would be like the iPad. Even though the iPad tablets have been out for a while, it wasn't till the iPad that the wave hit. And we just saw HP sell their PC business, and that was only 2 years ago that the wave hit, and it's gone. It's like a tsunami. And then there's like the next level of search, which hasn't hit yet, but pretty soon we're going to be out of the Boolean world in search, and we're going to have to go to smart search, and we don't know what that looks like. So for the guys who are trying to do like next wave work, what would be the key thing besides persistence that you would want to see them focus on? And for the guys that, or girls that want to do incremental improvement in existing industries, what would be some advice you'd give to them?
I think one of the biggest things we can learn from this device, since you used the example, is that this device is not about just looking great and having functionality, which it does, but I think what made this device a big hit is what it doesn't have. And I think one of the beautiful tenets of good design is perfection is achieved not when you're adding things, but when you run out of things to take out. So I think as great technical thinkers, sometimes the fallacy that we fall into is like, in order to build the next wave product, we need to just fill it with a lot of features. But I think for it to be really, really successful, it has to be really simple, and it really has to provide that one value. And sometimes the hardest thing for us to do is just keep taking things out until that great functionality is achieved.
Okay, hi everyone. My name is Nan Liu, and I'm a student here at Berkeley. And I'm actually an international student from China. So I'm not sure if you are familiar with the conditions in China. Right now, China is really excited, and it's not that hard for fundraising when your company is matured enough. But still, the investing conditions in China is really unregulated because, based on the different ideologies of China and US. So, let me give a little brief introduction. So, usually during the first round, fundraising, no one will really care, and the investors and the angels will sometimes invest their money usually based on how much they like the entrepreneurs, and for my friends, many of my friends, they have enough money at the startup, but they really need help from the angels in terms of how they could network with other people, as Joe said, how they could get help on employment and other stuff, and during fundraising during stage C, and there might be competition between different VCs and angels, and sometimes there will be some immoral competition. So and some other issues. So as the panelists talk about the relationships between the entrepreneurs and investors, I want to ask from the Chinese perspective, or how you feel about China, other places. What do you say about the morality and responsibilities of an investor, and how, based on your experiences? Thank you very much.
So I think, Aydin, you're the only guy who's invested in China here.
Well, I have done deals in China.
Done deals.
And I have Greater China LPs, but I have not done a deal in China. But I think two things I can say. One, first of all, I think Steve Bengston did a gang-up job. And even though I don't remember every single statistic, I know China was up there and certainly doing really well. One thing that I can tell you also from experience, very limited experience of only doing this for 5 years, but having invested alongside of investors like Ron Conway, who's done it for 25, 30, 35 years, is that I think, just like Joe said, a few good hits, luck can help you. But the only way to consistently do well in this business is to have a really strong brand, right? I mean, investors come and go, money comes and goes, and if you really want to work with great people, you need to have a great reputation that is built one reputation at a time, and it takes years and years of hard work to build it, and one single bad move to destroy it completely, right? One pissed off entrepreneur. So I think this is not something that only applies to China, but applies to here too. I think as investors, we have to build our reputation one investor at a time and really earn it. And I think it's the same is true for entrepreneurs. You also have to have a reputation that people hopefully will want to reach out and work with you and give money to you or consult, whatever. So and I think the same has to hold true in China. And when the market is so that there are 2 investors and 1,000 founders, it's easy to get away with a lot of bad stuff. But as we have all seen, markets turn around. So I think you have to have a long-term perspective.
Joe and Howard, do your funds invest in China?
No, not right now.
Okay. You're up.
Yeah, my name is Lars Følere. I do a PhD in entrepreneurship. I have a question about startup accelerators. You have, for instance, Y Combinator and Techstars that put you through a program. You get a lot of mentoring. You can get help with setting up the company, legal-wise, all that. And at the end, you typically have a demo day. I'm wondering how valuable you think that is, in terms of, do you see any good deals coming out of that? And is it more for angels, or is it also interesting for venture capitalists?
So, actually, I think those kinds of programs are valuable. I mean, at Google Ventures, we're setting up something called Startup University, which is basically for the 80-plus seed companies we'll do every year. We basically run a ton of classes, like how to do quick and dirty user testing, how to run a great engineering organization, what are best practices, how do you successfully source and select engineers or product managers or designers. There's a lot that can be taught through real hands-on workshops that I think are valuable coming from people who have done it before. So I think the mentorship, the teaching is really valuable. But probably the most valuable thing is actually the intercompany networking that builds up. So, Y Combinator's class this year is what, 63? 63. Is that right? Yeah, it's a big class. But a lot of the value actually comes, I think much in the way, I didn't go to business school, but I hear a lot of business school is about the kind of building the network. So I happen to be fans of those programs. I think they benefit the entrepreneur also because they create kind of feeding frenzy mentality through kind of presentation, demo day, creation of scarcity, fear of missing out, in terms of generating higher prices. I don't know whether they generate better outcomes, but they certainly, I think I haven't looked at the data, but I would presume that they get funded at a better rate than the average entrepreneur.
Well, it certainly is a big trend in Northern California, Silicon Valley. There's been a plethora of new accelerators and incubators. And with Y Combinator, as I think you know, if you get in, you're essentially guaranteed seed funding. And so it kind of speaks to the world we live in today.
I'm just going to tell you, I've invested probably in a dozen YC companies. I'm an investor in both of the YC funds. I'm an investor in at least one Techstar company, one seed camp company. That doesn't mean that I do hundreds of deals, by the way. But and I can think of at least one company for each one of those that has done well. I can also think of companies that I've been involved that haven't done any incubators at all. And I think I would say, Joe, I think hit the nail on the head. The camaraderie in the network is probably one of the biggest assets. And also it's selective. Like if you get into a school that is really hard to get into, of course it's a great feeling of achievement, but also the other peers that are there, like I think you learn a lot through them as well. And I think the important point is there's no single path to success. For some people, that's a great way to get to where they want to go. And I think another great point that Joe made and also Howard, I think, made is that the dots kind of connect, and you just have to have faith. So sometimes that goes through incubators, sometimes that doesn't. But as long as you do something that fits what you're doing, and if that's something that can really, really help you, then I think so much better.
Yeah, and I think a really interesting part of accelerators and incubators is if you just look at the statistics, the failure rate is extremely high for those companies, but all of the founders who do it, they learn something and they meet people and they network. And if they fail, they're all going to start, maybe 80% are going to start something new, and they now have the learnings from what they learned the first time around. You don't need to go to Y Combinator twice to get the lesson. So if you don't make it the first time around, you've learned enough from that, to help you the next time around. So I think they're too early to see this yet, but probably in a few years, we'll be meeting entrepreneurs who say, yeah, here's my history, and I went in YC, and then that company didn't make it, but now here's what I'm doing. And I think that will be a very common thing that we'll see in a few years from now.
Thank you.
So my question at the high level is, how should we as entrepreneurs split our time between marketing and networking and building? So let me just explain a little more. I'm a computer science student, which means I love building things. And most of the people I know in computer science also love doing this. We're not as good at networking or talking to people in general. So I know that other people in this room are probably much better at figuring out what would sell or how to organize or structure a business or who to sell to or how to recruit. I want to have huge impact in the world personally, and I think that's what defines me as an entrepreneur and probably everybody else here. I have something I'm really good at, which is writing software. But how do I decide how much time to invest in introducing myself to you folks after this meeting, or should I just go back to my, dark office and continue hacking and doing what I love? And what are the strategies for different personality types that you can recommend for really successful entrepreneurs?
So I think the answer here is just team structure, and I signed a term sheet with a seed investment for a couple $1 million this morning, and it's 3 students fresh out of school, and it's 2 engineers and 1 business person. And the business person came and I met her at Stanford, and she was telling me what they were doing and doing all this research and talking with all sorts of companies and networking and learning everything about the market. And I said, well, next time let's bring the team. And she's like, well, they won't say anything. And she brought her 2 engineers to the next meeting, and I had to, I finally got them to give me a demo, and then they lightened up a little bit because they were showing me what they had been building. So I think the simple answer is, it's okay if it's just a bunch of developers, and then you have to spend some percentage of your time doing the other stuff. But the easiest thing to do is get another team member and build the company out to have somebody who can happily fill that role, instead of you having to fill that role if it's not something that you like to do.
And I think the only thing I would add to that is, as an entrepreneur, you have to wear many hats. Some of them are comfortable, some of them not. And if you just want to do and stay in your comfort zone, I think the easiest thing to do is just take a job. But if you're going to get into entrepreneurship, the thing you realize very fast is you need to do things that you're really good at that hopefully carries you, but you also have to learn a lot of stuff on the way, and you just have to do it. And I think you're already half the way there, because it sounds like you have co-founders or at least co-conspirators. So at least you guys are sharing, and you can at least as a group help each other and maybe decide okay, we're all programmers, but this person is a little bit more outgoing, so that person could do the networking and so on and so forth. So I think that's a good starting point.
Thanks.
2 more questions, and then you can come up and talk to these guys briefly.
Hi, my name is Kevin. I'm a student here. Thanks to everyone for being here. I was wondering if you could tell us about some of the investment opportunities that you most regret passing up. Are there lessons about issues that you thought were unsolvable at the time that it turns out that they could turn around and overcome those obstacles? Thanks.
I would just briefly say the few that I've regretted missing so far. I passed on Twitter at the Series A, and I passed on Square at the Series A. And in both of those cases, the prices just seemed ridiculous to me. And live and learn, hopefully I won't do that again in the future. But we're trained that you buy low and you sell high. You don't buy high and pray. But in some cases, the pitch that Square had was pretty awesome, but the price just made, I've never paid that much for a Series A, and I just couldn't get over it. And I'm friends with Jack Dorsey, and I said, I'm just not going to do it. And he found Gideon Yu to do it, and Gideon paid 30-ish million, and now it's at $1 billion or whatever it is. Yeah, they're wonderful guys, and it's a wonderful company. So my biggest lesson there has been, if the market is saying this is what it is, if you really love something, sometimes you got to pay a stupid price for something, and then when it fails, you kind of go, well, nobody will know what I paid, and when it succeeds, then you just don't make nearly as much money as you would have if you had paid the price you wanted to pay.
Excellent. Last but not least.
Thanks. Hi, my name is Michael. I'm a first-year MBA here. So I really appreciated Andy's question. I'm exactly on the opposite end of his question, in the sense that I'm a business student and I have a lot of great ideas, and I'm really looking for people to build. We should talk after this. And what I'm curious to hear is, so if I have these great big ideas and I'm looking for people to implement them, at what stage would I approach you guys for seed, or what do you need me to do so I can get the money to bring on Andy to code for me?
I mean, generally speaking, we at least tend to fund, at least if it's either just a pure engineering team or a product person and an engineer. Like, I don't think we've funded teams that don't have engineers behind them because.
Sure. I guess what I'm saying is, do you need a prototype? Like, how much do you need accomplished?
It's interesting. I would say we do fund some just pure ideas, but for the most part, prototypes. So there's a few things. Sorry. One is you should definitely get co-founders because it makes a big difference. Preferable if you've worked together in the past. These are all things that lead to better success because you've solved problems together in the past. In terms of what you need, I feel like prototypes are definitely what I'd like to personally see, mainly because it gives you an indication of what the turnover, the turnover rate or the throughput or the tempo or the tempo of the company is going to be. And something that's just paper, when you have engineers on board, just doesn't feel quite right to me. I feel like I should see something. I want to see low fidelity prototypes. I want to see kind of a high velocity in terms of the turnover of the company. I don't know, it's a generalization, but I don't know what you guys think.
I mean, I wish I had a standard answer to that, but I was just thinking of two anecdotes. One was I just recently was having this conversation with an entrepreneur. We didn't end up proceeding, but she literally had this idea that was, I'm not going to say obscure, but it was like a very marginal thing. But what was amazing is she not only took the idea, but found 3 amazing programmers to build one of the most beautiful sites I've seen to actually implement it. I was just blown away. I think I almost said, I'm going to invest in this company because I can't believe you took that idea, you sold it, you got these people to develop the product, and I'm using this and I'm thinking, how did you get these guys to build it for you? Just on your vision alone. The second thing is, I was just, again, talking to an entrepreneur today. It's a team of 2 engineers and 1 business guy, and we were talking to the business guy, and I'm a sales guy, product, but I wasn't an engineer. I programmed a little bit, but we kind of asked him, well, how did you happen on this company and what were you doing? And the guy said, look, he told about 3 big distribution deals he closed and the company is 2 months old. I'm like, what did you do? He's like, well, I started there was this company huge, hundreds of millions of customers. I started at the customer service number, called them 10 times until they gave me the number of the company, then called the number, spoke to the receptionist. I spoke to the receptionist, said, this is exactly what my product does, and receptionist loved it so much that connected me to the VP of the company. So I mean, if that guy is willing to do anything, he's we're staying in this apartment, and I put the headset so people don't hear the crazy noise in the background, so that they think we're in an office, but I'm in this place where we also live, and there's crazy noise. So we're all starting from humble beginnings. And it's kind of like lemon into lemonade. Some people can say, oh, I have all these things, I don't know how to get out of it. And some people are like, you know what, I'm just going to use imagination, good humor, and good attitude and figure out a way until I get to the point that I need to get to. And I'm so sorry to repeat this the 3rd time, but you do whatever it takes. If you can sell people on your vision alone without no engineers, then that's the answer. If you're not getting the answer and everybody's kind of starting to move away in the 30th second, that's also your answer. So I don't think there is a standard answer. It's just whatever you can get away with.
Come full circle.
Well, that was an absolutely fantastic event. I want to thank Sam and Fenwick West.
Thank you.
For putting the panel together. Thank our panelists as well. And our next event is on September 22nd, and it's food entrepreneurship, and we're going to have great food as well as great entrepreneurship. We'll see you then.